Yo, streaming stock slingers and merger mavens, this FuboTV fork in the road is a roller coaster. It's Area 72, your high-stakes war room for market maneuvers, cord-cutting carnage, and analyst alerts that turn deals into dilemmas. Today, we're ripping into Seeking Alpha's fresh take on FuboTV. Fubo, rated a cautious hold amid the Disney merger buzz, weighing scale dreams against brutal operational headwinds, weak growth, and profitability pitfalls. If this balanced bet has you eyeing Fubo's future, smash that like button, slam subscribe, and crank those notifications. We're dropping these explosive breakdowns to supercharge your portfolio plays and watch time. Let's dissect the dilemma, spotlight the stakes, and sling a prediction that'll spark debates. Comment now, merger magic or merger mirage? Let's dive deep, full throttle. Flash to the fiscal fork, September 2025, Seeking Alpha's Stephen Ayers drops the hammer on Fubo, slapping it with a hold rating that screams, proceed with caution. The thesis? FuboTV's staring down two paths, a potential Disney merger that could unlock scale, ESPN/ABC carriage, and margin magic, or a standalone grind plagued by sky-high content costs, anemic growth, dilution dangers, and no clear runway to real profitability. Ayers nails it. Fubo's merger with Disney could deliver scale, ESPN/ABC carriage, and margin uplift, but does not guarantee long-term success or defensibility. X is buzzing, #FUBO merger trends with 500k plus views, traders trading upside versus undertow memes. Fun fact, Fubo's Q2 revenue ticked up 17% to $334 million with 1.5 million subs, but churns the ghost in the machine, 58 big swings over 5% last year alone. Like if you're holding Fubo, comment your merger hot take, the merger mirage unpacked, path 1? The Disney dream, fusing Fubo Sports niche with the Mouse's empire could crank synergies, snag premium content, and boost subs to 5 million plus by 27. Ayers concedes, merger upside with Disney as a bright spot, potentially slashing costs 20% and unlocking $1 billion plus revenue streams. But the but? Integration nightmares, regulatory red tape, and no lock on defensibility. Disney could swallow Fubo whole or spit it out slimmer. Standalone? Path 2's a pothole parade, content bills ballooning to 60% of revenue, growth stalling at 5 to 7% CAGR, and dilution from endless stock offerings to stay afloat. Ayers roasts, standalone Fubo faces high content costs, weak growth, dilution risk, and lacks a clear path to sustainable profitability without the merger. Quote that cuts, current valuation reflects merger optimism, but risk-reward is unattractive until synergy realization is proven and financial metrics improve. Broader stakes? Streaming's $100 billion US pie is a shark tank. Fubo's 2% share fights Netflix's 30% juggernaut, with churn at 8% quarterly. Share this split, let's fork the future. Investor intel ignited, Ayers hold is a hedge, bulls bet on merger moonshots. Fair value whispers $4.50 average from community, 7% upside from $4.20, bears on bleed out, short interest 15%. Projections? Revenue to $1.8 billion by 2028, 3.8% CAGR, earnings to $200.4 million, plus $112.7 million from $87.7 million current, optimistic if Disney dances, dire if solo. Risks? Churn spikes from price wars, Disney's recent hikes a warning, dilution from $100 million plus raises. Upside? Niche sports lock-in during NFL/MLB seasons. Prediction, merger talks fizzle by Q1 26, Fubo dips 15% to $3.50, then rebounds 25% on standalone sports tier launch, hitting $4.38 by year-end. Upside? Synergy saves. Downside? Bleed to break-even 28. Twist? Disney walks, Fubo snags Peacock partnership, sports streaming savior. That's your FuboTV fork in the road. If this forked your forecast, like, subscribe, bell on, next merger madness. Comment your path pick, share the stakes. Thanks for navigating with Area 72, stay merged, stay mighty. #SETHJTV